Hello and welcome to the latest instalment in my series of podcasts in which I give tax and other practical advice to families. My name is Claire Charlton and I am head of the Personal Tax and Trusts team here at Rycroft Glenton. And in the course of my work, I have come across various practical tips which I would like to pass on in the hope that they will help you or a member of your family in the future. Now, this latest episode is entitled, Should I Be Skiing? And of course, skiing in this context is spending the kids' inheritance, which is of course a reference to an inheritance tax planning technique, which is to spend your money so that it isn't in your estate for inheritance tax purposes on death. Now, whilst it is a perfectly valid technique, it is a bit crude because it doesn't take into account the balance that needs to be achieved between giving money away to avoid inheritance tax and the capital gains tax implications that can arise if you try to give away non-cash assets, and the fact that you don't want to leave yourself short should you need capital in the future for things like nursing care. So in this podcast, I'm going to talk a little bit about some of the things that can be done to plan for inheritance tax and the benefits of having an inheritance tax review. Inheritance tax is an emotive tax, partly because it's associated with death, and so it's difficult to talk about, and also because it feels like a second bite at the cherry by HMRC, because often the wealth in people's estates has been built up from accumulated earnings and things that have already been taxed, and so to tax them again on death seemed unfair. Also, rising house prices have pushed some estates into inheritance tax which wouldn't have suffered tax in the past. The good news is that there are quite a lot of techniques for minimising inheritance tax. And so in this podcast, I'll explain what's involved in an inheritance tax review and how you might benefit from such a review. The starting point for an inheritance tax review would be a copy of your most recent will, and we would look at that and understand the terms of your will and how you wish your assets be distributed. We would also need a rough idea of what is in your estate, so bank balances, value of investments, value of any properties. If you have a business, then we would need to understand how the business is structured and the assets within the business. And if you're the beneficiary of any trusts, then we would need to understand your entitlements under the trust and what might be included in your estate on death. The second step would be for us to use all of that information to make an estimate of the inheritance tax that would be payable under the current rules and using the current valuations of your assets, just to give you an indication of what the position would be if no further action was taken. Now, depending on the complexity of your estate and the terms of your will, we may have to have some discussions with you before we could prepare our final report. That report would include details of the current inheritance tax exposure of your estate, and then it would set out a series of suggestions and ideas as to how you might reduce your inheritance tax exposure by making use of all of the various allowances and reliefs that are available for inheritance tax purposes. The report would look at things like the scope for making gifts, and in the case of a married couple, who's best placed to make those gifts. It would look at ownership of assets and whether they should be in joint names or sole names. It would include, where relevant, techniques for diverting inheritances from other people in your family in an attempt to minimise the accumulation of wealth in a particular generation of a family to avoid multiple inheritance tax charges on the same assets. We would also give advice about maximising the nil rate band, which is currently £325,000, being the first slice of your estate, if you like, which is not subject to inheritance tax. For the last few years, there have been some quite complicated rules around inheriting unused nil rate band from your spouse and a special nil rate band which applies in certain circumstances to your main residence. We can also provide you with details of a very valuable inheritance tax relief which involves giving money away during your lifetime from your surplus income. If you have income that's surplus to your requirements, then allowing it to accumulate as cash in your bank account simply increases your exposure to inheritance tax. So the idea of this relief is to stop that from happening. Now, there are some quite strict record keeping requirements and we can provide guidance on those, but it's well worth a little bit of administrative burden to secure this very valuable inheritance tax relief. So I hope that's given you a flavour of what might be involved in an inheritance tax review, and I would encourage you to get in touch with me if you would like to discuss the possibility of an IHT review, and we can talk about what would be involved in your particular circumstances so that you're able to make an informed decision about whether a review would be appropriate. That brings me to the end of this podcast, and I do hope you'll join me for future episodes in the series. Thank you.